All right, we're going to look at income statement presentation under both absorption costing and variable costing using this example here. So Vivian Manufacturing Company produces basketballs for professional leagues in North America. The following information relates to the production and sale of Vivian Corp's basketballs for fiscal year 2018. Just a side note, huge basketball fan, so you'll see lots of examples related to basketball. So if you're not a fan, my apologies in advance. But you see the information here. Sales price per basketball of $95 a piece. Variable production cost per basketball of $35 a piece. Variable selling and administrative expenses per basketball of $10 a piece. Fixed manufacturing overhead costs for the year, so not per unit or not per ball, 200,000. Fixed selling and admin for the year, 65,000. Units produced this year and units sold were 7,500. So something there that should kind of jump out, and I want you to start thinking like this. If I were to ever ask you, what is the difference in income between absorption and variable costing, it's all predicated on the difference between number of units produced and the number of units sold. In this scenario where they're the same, units produced and units sold, you should get the same amount as far as income. So just a heads up there. But we want to prepare an income statement for Vivian Corp under both scenarios, under absorption costing and under variable costing. So if we look at the information, if we look at the first scenario, we're dealing with absorption costing. So remember, under absorption costing, our product cost, so the items that end up in cost of goods sold, is direct material, direct labor, variable manufacturing overhead, fixed manufacturing overhead, all are included there. They've already given us the variable production cost per unit. So I'm skipping ahead here just a little bit. And let me just highlight here that we're dealing with absorption costing in this example in part A. $35 per unit. We can assume that that's the direct material, direct labor, and variable manufacturing overhead. What we need left to do first is to calculate the fixed manufacturing overhead per unit. It's the total fixed manufacturing overhead cost for the year, in this case, the 200,000, divided by the units produced, which was 7,500. We get a fixed manufacturing overhead of approximately $26.67. We add that to our variable production cost per unit of $35. We get a COGS, or cost of goods sold per unit, of $61.67. That'd be very expensive basketball, $61,000 basketball. I'd love to see that. But we get a cost per unit, product cost per unit under absorption costing of $61.67. The format for your income statement under absorption costing, remember, should be that gross profit approach where you have sales less cost of goods sold equals gross profit. And that's exactly what we have here. We start with sales. Sales are the number of units sold, which was 7,500, times the selling price per ball, which was $95. So we get sales revenue of $712,500. Then we calculate our cost of goods sold, which we just calculated the per unit amount above, which was $61.67. We multiply that by the number of units sold, which was 7,500 units. So we get cost of goods sold of $462,500. Subtracting the two gets us to our next line item, which is gross profit. The difference between our sales and our cost of goods sold, that's our gross profit of $250,000. Then we subtract out the remaining operating expenses. In this case, the only expenses we have left are the variable selling and admin, which is $10 for every unit sold of 7,500. So we get $75,000 in variable selling and admin. And we have our fixed selling and admin, which was a flat $65,000 for the year. Our income under absorption costing is $110,000. Key thing to notice here is the format of the income statement under absorption costing. I cannot stress it enough. Utilize that gross profit approach. Now, part B asks us to calculate or to prepare the income statement under variable costing. And under variable costing, we're going to use what we call a contribution margin income statement. The starting point is going to be the same. Sales is obviously going to be the same. It's going to be $712,500. The difference is under a contribution margin income statement, we separate out our costs not by product versus period costs like we did up here. That's essentially what we've done. Our product costs are cost of goods sold. Period costs are the variable and fixed selling and admin. Under the variable costing income statement, we separate and classify our costs out by their cost behavior. We start with variable costs first, then we have fixed costs after contribution margin. So on this income statement, we take our sales, then we're going to subtract out our variable costs of goods sold, which is our variable product costs. That was $35 a piece. Remember, that was given in the question. We multiply that by the 7,500 units that were sold. And then we're also going to subtract out our variable selling and admin, which was the $10 per unit times the $7,500 units we sold. The sum of those two gets us our total variable costs. You can see we're going to add the variable cost of goods sold and the variable selling and admin. We're going to add those up. We get total variable costs of $337,500. We subtract that from sales to arrive at our contribution margin. And remember, contribution margin is the difference between sales and variable costs. We get a contribution margin of $375,000. Now that contribution margin is left to cover our fixed expenditures, our fixed manufacturing overhead, which was $200,000, our fixed selling and admin, which was $65,000. And notice our income is still $110,000. Now, 316 asks, continuing on with the same data from exercise 315, Vivian Corp produced another 7,500 units in 2019, but only sold 6,000 units. Assuming no other changes to costs and to sales price, prepare the appropriate income statements for 2019, assuming they use absorption costing, and then assume they use variable costing. Which method reports higher income? Why is that the case? So we're assuming the same costing information, sales price of $95, variable cost of $35, variable production cost of $35 per ball, variable selling and admin of $10 per ball, fixed manufacturing overhead of $200,000, fixed selling and admin of $65,000. They produced 7,500 units, but they only sold 6,000. So based off of that, we're going to prepare income statements under this new scenario. So if we scroll down, we want to figure out our fixed manufacturing overhead per unit. Again, our fixed manufacturing overhead, it's the total fixed manufacturing overhead incurred for the year of 200,000 divided by the units produced. So it's still going to be that 7,500. We're still going to get fixed manufacturing overhead of $26.67 per ball. Variable production costs remain the same at $35. So our cost of goods sold under absorption costing is still going to be $61.67. Our income statement under absorption costing, remember here, we're only selling 6,000 units, not all 7,500. So just keep that in mind. Our sales, it's the 6,000 units sold times the $95 sales price per unit. Cost of goods sold, we're going to take our cost of goods sold per unit number of $61.67. We're going to multiply that by 6,000 units sold. That gets us to gross profit of $200,000. And that's, again, the difference between our sales and our cost of goods sold. Our variable selling and administrative expenses, it was $10 per ball. We sold 6,000 balls, so we get a total variable selling and admin of $60,000. Fixed selling and admin is just a fixed amount for the year. It was $65,000. That gets us an income level of $75,000 under absorption costing. Now look at the variable costing income statement. And this is where, again, we'll see we will not get the same income. You can already look, we had 75,000 under absorption costing income, but for variable costing, we're going to report income of 35,000. So how do we get to that number? Well, sales is going to stay the same. It's still the number of units sold, which was 6,000, times the sales price of $95 a piece. Under the variable costing approach, our income statement should follow the contribution margin approach. So we're going to subtract out all of our variable costs first. Our variable cost of goods sold was $35 a piece times the 6,000 units sold. So we're going to have variable cost of goods sold of 210,000. Variable selling and admin, same approach. It was $10 a unit times the 6,000 units sold of 60,000. Our total variable costs are $270,000. We subtract that from sales to arrive at our contribution margin of $300,000. And again, that's simply the difference between sales and contribution margin. Then we subtract out our period costs, or our fixed costs, I should say. Fixed manufacturing overhead, we're going to expense the entire amount under variable costing, so 200,000, and our fixed selling and admin of 65,000. We subtract those two from our contribution margin, we get an income of $35,000. So why is there a difference between absorption and variable costing in this scenario? Well, the reason there's a difference between the two is because there's a difference between the amount produced and the amount sold. Remember, I said in an earlier question, under variable costing, that fixed manufacturing overhead of $200,000 is expensed immediately. So all 200,000 is going to show up on the income statement under variable costing. However, under absorption costing, the fixed manufacturing overhead per unit of 2667, only 6,000 units worth of it is going to show up on the income statement, which if you do the math, that's 160,000. This is the amount of fixed manufacturing overhead that is on, oh, excuse me. This is the amount of fixed manufacturing overhead that is embedded in cost of goods sold under the absorption costing approach. So in other words, the biggest difference between the two income statement is the amount of fixed manufacturing overhead expense incurred. Under absorption costing, we're only reporting 160,000. Under variable costing, we're reporting the entire 200,000. So variable costing is reporting 200,000 or $40,000 more in fixed manufacturing overhead expense. Therefore, their income is going to be $40,000 less than the income level reported under absorption costing. And it's all because of the amount of fixed manufacturing overhead that's reported on the income statement under variable costing versus absorption costing. And you can see the reconciliation here, how we arrive at that difference in income of 40,000. It's the amount of fixed manufacturing overhead reported under variable costing versus absorption costing. Under variable costing, as we said, the entire 200,000 is going to be reported. Under absorption costing, that's not the case. It's only related to the 6,000 units that are going to be sold, hence the difference of 40,000 in fixed manufacturing overhead and therefore in income.